In March 2026, Bangladesh's dollar reserves fell below safety levels. The IMF stalled a $1.3 billion bailout, demanding austerity, fuel price hikes, subsidy cuts, a risky taka float. Street protests are brewing. This is the fourth IMF rescue in a decade, but this time, it's not a rescue. It's restructuring the entire economy, and it all traces back to one shock. March 2026. Bangladesh's central bank counts the dollars left in its vault, and the number stops at 30.5 billion. Sounds like a lot. It isn't. That's less than 4 months of imports. Below the IMF's recommended safety line. Then the call from Washington came. The International Monetary Fund stalled the next tranche of its $5.5 billion package, a $1.3 billion payment due in June, citing missed targets on banking and tax reform. For a country that imports its fuel, its raw cotton, its machinery, running thin on dollars means trouble at every checkout. The price of rice, the price of diesel, the price of the phone in your pocket. Foreign investors read the IMF freeze as a verdict. Money started moving out of local currency debt. The taka came under fresh pressure. And the question hanging over Dhaka now isn't whether the IMF will hand over the money, it's what it will demand in return. Because this time, the fund isn't proposing a patch, it's proposing a rewrite. We'll see exactly how that proposal landed in the Prime Minister's office, and why his economic team didn't see it coming. Before you can understand why the IMF holds that much leverage, you have to understand what Bangladesh actually sells the world. Walk into any clothing store in London, New York, or Berlin. Pick up a t-shirt, a pair of jeans, a fast fashion jacket, flip the tag. Made in Bangladesh shows up more often than almost anywhere else. The country built a $30 billion garment industry from almost nothing, second only to China. Roughly 4 million workers, mostly women, on factory floors in Dhaka, Chittagong, and Ghazipur. It's the engine that pulled Bangladesh out of poverty over 3 decades. But the engine has a fatal design flaw. Bangladesh doesn't grow its own cotton at scale. It doesn't make its own dyes, its own zippers, its own industrial sewing machines. It imports them. It imports the fuel that runs the factories. It imports the diesel that ships the containers. Every shirt sold abroad needs dollars spent abroad first. When global oil spikes, the model groans. When the dollar gets scarce, the model buckles. One bad season in the import bill, and the country that closed the world can't pay for the thread. That's the trap. And the trap just sprung. Watch what happened to the reserves. $27 billion in July 2023. Then a brutal slide to just $15 billion by February 2024. A 44% collapse in 8 months. The recovery to $30.5 billion looked solid. It wasn't. The data we reviewed projects reserves dropping to $26 billion by June 2026, without the stalled IMF tranche. That $4 billion gap is the danger. That projected drop is what gave the IMF its leverage. On May 4, 2026, the fund moved from rescuer to surgeon. The proposal it sent Dhaka wasn't an extension of the old $5.5 billion package, it was a rewrite, smaller in size, longer in tenure. Higher interest rates, because Bangladesh's bargaining position has weakened, and the conditions are harder than anything the country has accepted before. Binding quarterly revenue targets, meaning the government has to hit tax collection numbers every 3 months or face suspension. Accelerated recapitalization of weak banks, billions in fresh capital the budget doesn't have. A fully market-based exchange rate with no quiet intervention from the central bank to soften the fall. And, for the first time, governance benchmarks tied to anti-corruption prosecutions. The fund wants people in court. For the BNP-led government that built its economic pitch around smooth IMF engagement, the message stings. Dhaka asked for a bridge. It was handed a contract. and the conditions inside it could push fuel and electricity prices high enough to put people on the street. The government has limited alternatives for foreign financing, so acceptance is expected, despite the cost. While the IMF tightened the screws, another phone was already ringing in Beijing. China watched Washington hesitate and moved. The numbers tell the story. A $400 million loan to modernize Mongla Port, Bangladesh's second largest. $350 million for a Chinese-led industrial economic zone. Another billion in private commitments. Solar panel manufacturing, healthcare, agro-processing, footwear, tourism, IT. Roughly $1.75 billion in pledged capital just from this round. The seeds were planted in March 2025 when Mohammed Yunus, then chief advisor of the interim government, flew to Beijing and met Xi Jinping. One agreement. 8 memorandums of understanding. The deals weren't expected to finalize before 2026. China wanted to see who won the election first. The election came. The BNP won. The financing started flowing. For Dhaka, the math is simple. The IMF demands austerity, prosecutions, painful price hikes. Beijing offers concessional loans without the lectures. The trade-off is also simple and quieter. Mongla Port becomes a Chinese-built, Chinese-financed gateway on the Bay of Bengal. The industrial zone runs on Chinese terms. The country that once tilted toward Delhi and Washington starts leaning somewhere else entirely. Yunus handed off. Tarique Rahman's BNP government inherited the dilemma and the deadline. The party that built its economic case on smooth IMF engagement is now being asked to swallow the harshest IMF program in its history. Fuel prices rising, electricity prices rising. The taka allowed to float, meaning the cost of every imported good, from cooking oil to medicine to motorbike parts, jumps with it. And Rahman's window is narrow. He just won an election. The public goodwill is fresh and finite. Push the austerity through now, before street anger has time to organize, and the program might hold. Wait too long, and the next round of protests writes its own ending. Bangladesh has been here before. Fuel hikes have triggered marches in Dhaka, Chittagong, and Sylhet in past cycles. Garment workers, 4 million of them, the engine of the export economy, are not a constituency any government wants angry. The calculation in the Prime Minister's office isn't really economic anymore. It's political timing. How much pain, how fast before the patience runs out. And nobody in the cabinet knows the answer. The first IMF-linked price hike is the one to watch. Step back from the headlines, and the bigger pattern shows up. This isn't a bad quarter. It's a model running out of road. Bangladesh's garment-led export miracle, built on cheap labor and imported inputs, was always exposed to the price of oil and the supply of dollars. For 3 decades, the global conditions cooperated. They've stopped cooperating. Fuel costs swing harder, dollar liquidity tightens faster. The IMF, once a backstop, is now an auditor with subpoena power. Meanwhile, the country's options narrowed in another direction too. Washington's aid future is uncertain. Delhi's relationship has cooled since the political shift of 2024. Beijing has the checkbook open, the terms friendly, and the ports it wants on the map. The data we reviewed points to that shift continuing. Dhaka tilting further toward China as the IMF program bites and Western bilateral aid stays thin. The deeper change isn't who Bangladesh borrows from. It's that South Asia's economic order is being rewritten in real time. A model that lifted 170 million people out of subsistence is being asked to evolve, under pressure, on a deadline, with the bill from 3 decades of imported growth finally coming due. The trend the numbers expose is a country running out of cushion just as the world stopped being patient. The next chapter belongs to whoever holds the dollars. This is not a cyclical wobble. It's structural. Like and subscribe for the geopolitics that actually matter. See you tomorrow.